Friends, welcome to our today's session. And let us continue our discussion on salary chapter. And previous session, we are discussing about the concept of Provident Fund, how Provident Fund contributions will be exempt, how employers' contribution, employees' contribution will be dealt at a very basic level we have discussed. And at that time also, I had told you that we'll repeat this concept, that Provident Fund concept in the next session. So today, first we'll recapitulate what you've understood. After that, we'll move ahead. So let me first share my screen with you. So I'm sure most of you must be aware of that. What is Provident Fund? Yes or no? You are aware of it?
Yes, sir.
Okay. So Provident Fund, what happens normally? Most of the Provident Fund that we talk about, employees Provident Fund. Contribution come from employee as well as from employer. Both of them contribute. Okay. Normally, there are different types of Provident Funds. We'll be understanding all of them. Employee contributes 12% of the salary. In some situations, it may be 10% also. Employee contributes 12% of the salary towards employees Provident Fund. Employer also contributes something. How much employer contributes? If you look at this picture, you can understand that the employer contributes 3.67% towards EPF, 8.33% towards EPS, that is Employee Pension Scheme. EPF is Employees Provident Fund. Then 0.5% towards EDLI, that is Employees Deposit Linked Insurance. Then 1.1% as employee employee pension scheme. Then then this thing 1.1% is for administration charges of this. Then 1.01% as you see the EDLI admin charges. So like that, employer contributes, employees contributes. So normally PF Act is applicable to a factory or to a business, to an establishment where 20 or more employees are there. Employees where there are less than 10 in an establishment where there are less than 10 employees, they can also voluntarily go for adopting EPF Act. In that case, that the employees need not contribute 12%, they can contribute 10% also if they voluntarily adopt. Okay, so this is the basic things, but in detail, if you want, you have to refer to the PF Act. So if you look at here in this table, you can understand that employee is contributing towards EPF 12%. Employer, all these components taken together actually contributes 13.61%, and total contribution comes to 25.61%. Okay, this is for your basic understanding. And these contributions are statutorily payable up to a prescribed wage ceiling, which is as on date is 15,000. So up to, if the employees are drawing wages up to that much of money, then employer is bound to contribute PF. Okay, so that establishment may go for registration if it is employing 20 or more employees, and he has to make contribution, as well as the establishment has to file return before 15th day of every month. So these are the requirements for a normal understanding. Just to have some basic idea about PF, I wanted to tell you all that. Again, you know, this PF money can be withdrawn. An employee on his retirement or attaining the age of 55 can withdraw the cumulative balances which are there in the EPF account in his name. He can withdraw the whole amount of his EPF along with employer's contribution. In case employee does not attain the age of 55 or is below 55 or retirement age, but it switches to another employee, he can also fully withdraw his EPF balance in case he is not in employment for 60 days. So normally at the time of retirement or when employee attains the age of 55, it can withdraw. Otherwise, also he can withdraw if he remains on employment for 60 days. Entire money can be withdrawn. Okay. Now coming to this taxability of these amounts, as we have seen in the previous class. Here also you can see we are classifying the provident funds into four categories. You can see one is statutory provident fund, second is recognized provident fund, third one is unrecognized provident fund, and fourth one is public provident fund. Okay, are you seeing it? Now, statutory provident fund, if you can see, this can be called as EEE. That means exempt, exempt, exempt. Here, employer's contribution to the provident fund, whatever money the employer is contributing, is not taxable. Employee's contribution is also not taxable. Employee's contribution is otherwise it is not an income, so it is not taxable. And whatever money employee is contributing, it can also avail deduction under section 80C of Income Tax Act. So you know 80C provides certain deductions, and the interest which is credited to this provident fund account is also fully exempt. Lump sum withdrawals also fully exempt. So as you can see, if it is a statutory provident fund, the contributions are exempt, interests are exempt, and the maturity value is also exempt, or lump sum withdrawal is also exempt. But if the same provident fund is a recognized provident fund, that means it's a provident fund which is recognized by Commissioner of Income Tax. It is not a statutory provident fund, but it is a recognized provident. Then here you have to see, here also it is EEE, but subject to certain conditions. Therefore, you can see we have written it like EEE with the star mark. Excess contribution over 12% of the salary is taxable. That means if employer is contributing up to 12%, fine. But if it is more than 12%, it is taxable. Excess contribution over 7,50,000 per annum is also taxable. So that employer, if we have to see the employer's contribution, if it is contributing more, then it will be taxable. Then this 12% of the salary will be computed for basic salary plus DA forming a part of retirement benefit. For commission, if it is fixed as a percentage of turnover. This is the treatment of employer's contribution. Employee's contribution is not taxable. It's not an income. Deductions from employee's contribution is available. Employee, whatever is contributing, can claim deduction under section 80C. And the interest credited to this recognized provident fund account is exempt up to 9.5%. But if the interest is more, then it will be taxable. Lump sum withdrawals are not taxable on retirement or termination after 5 years of continuous service. Okay, so if 5 years of continuous service is there, then lump sum withdrawals will not be taxable. This is about recognized provident fund. And if the provident fund account is unrecognized provident fund, then employer's contribution is not taxable. Employee's contribution is not income. Deductions from employee's contribution will not be available. Interest credited will not be taxable. So unrecognized provident fund, you see, everything is exempt, but finally it will be taxable. It is under EET scheme. EET means employer's contribution is not taxable. And interest is also not taxable. But when the finally maturity value or the lump sum will be withdrawn, here employer's contribution will be taxable as salary. Interest and employer's contribution will be also taxable as salary. And employee's contribution is not taxable. It is not an income. However, interest are not employee's contribution is taxable under the head income from other sources, because this is an interest on employee's own contribution that will be taxed under the head income from other sources. So this is under EET scheme. And if the provident fund is a public provident fund, then employer doesn't contribute here, because here the employee, or he may not be employee also. Provident fund, public provident fund or PPF can be opened by any of us, whether we're employed or self-employed, doesn't matter. Okay, so employer doesn't contribute here actually. employees contribution, that question doesn't arise, otherwise also that is not an income. Yeah, but whatever contribution is made, it is deduction is allowed under section 80C. Interest credited to this PPF is also exempt, and the lump sum withdrawals are also exempt. So this is about PP. This is about PPF for Public Provident Fund. It is also under EEE scheme. Did you understand, friends?
Yes, sir. Yes, sir.
Okay, friends. Now, what is the meaning of salary? I had explained you just now. It includes basic salary, DA, commission, if it is fixed as a percentage of turnover. How this accumulated balance of recognized provident fund will be treated, I told you right now briefly. Okay, this accumulated balance payable to employees and recognized provident funds shall be exempt in the hands of employee, but subject to certain conditions. What are these conditions? That employee must have rendered services of 5 years or more. Okay, after that, it will be, after that, if the lump sum money is withdrawn, then it will be exempt. The first condition is that services rendered must be 5 years more. And services of previous employer also will be included for this purpose. Services rendered with previous employer shall be included if the previous employer also maintained recognized provident. Okay, so total 5 years one is to see. Then some other conditions are also there. If employee has been terminated, that means 5 years has not been completed, but terminated for certain reasons like ill health of employee, discontinuance of the business of the employer, completion of the project, for these reasons, for which employee is employed. Okay, in that situation. Or if employee has resigned before completion of 5 years and joined another employer who is maintaining recognized provident fund. Okay. If the balance is standing to the credit of the employee is transferred to the account under a pension scheme. So in these situations also, this lump sum or maturity value will be exempt. That was about RPF. Now about the unrecognized provident fund. So here treatment will be like this. Lump sum payment received from unrecognized provident fund will be taxable. Okay, will be taxable. That means it is not exempt. Okay, so how it will be taxable, which you have discussed right now. That payment received in respect of employee's contribution and interest thereon is taxable as salary. Payment received in respect of interest on employee's contribution is taxable under the head income from other sources. Okay, so this also I had told you at that point of time when we were seeing that table, that interest on employees' contribution will be taxable under the head income from other sources. Yeah, so one key point you have to remember here that is applicable for assessment year 22-23, that means it is applicable from this year onwards. That the provisions under section 10.11 or 10.12, this has been amended with effect from this assessment year. And as per this amendment, this exemption shall not apply to the interest income. That means interest income will not be exempt. Which interest income? Interest income accrued during the previous year in the Provident Fund account of the employee, to the extent it relates to the amount of contribution made by such person exceeding 2,50,000 rupees in the previous year in that fund on or after April 1, 2021, computed in such manner as may be prescribed. Now here you have to see what is not exempt. This provision talks about that interest income will not be exempt. So try to appreciate this. Interest income means interest income accrued during the previous year in the Provident Fund account of the employee, to the extent it relates to the amount of contribution made by such person exceeding 2,50,000. 2,50,000. That means if employee is making contribution up to 2,50,000, he did not have to worry. But if the contribution is more than 2,50,000, then on that excess amount, whatever interest is earned, that will be taxed. That will not be exempt. Did you understand this?
Yes, sir.
Okay, so this is a new concept you have to remember. Okay, what is recognized provident fund? We had discussed earlier. That means a provident fund recognized by income tax commissioner of income tax. Okay, so in detail you can refer to the slide. That thing. What is unrecognized provident fund means which is not recognized. Statutory provident fund means these are the provident fund which are governed under Provident Funds Act 1925. It applies to government, railway, semi-government institutions. Public provident funds are operated under Public Provident Fund Act 1968. It is open to every individual. One can go to a post office or bank to open PPF account. Okay, just now look at this chart. This talks about taxability of this thing, lump sum receipt, lump sum money which is received. Okay. Now here you have to see whether has the employee rendered continuous service of at least 5 years with the employer. If it is yes, it is exempt. If it is no, then we have to see why he is living. What is the purpose for which he is living? If it is because of ill health or contraction or discontinuance of employee's business or any other reason beyond his control. If that is so, it is exempt. If for any other reason 5 years continuous service has not been completed, then it will be taxable. Okay, this concept you keep in mind. So friends, with this, we understood the treatment of Provident Fund from income tax point of view. Now, here is one more important concept, that is National Pension Scheme. Okay, National Pension System, we need to understand what is this NPS system. Now, government employees and other employees may contribute 10% of the salary to NPS. Okay, employee can contribute 10%. Employer can also make a matching contribution. And in addition to that, employee can also contribute additional amount of 50,000, up to 50,000. Okay. Now you have to see what is the treatment. Employer's contribution. If whatever money employer is contributing, first it will be included in employee's salary. Okay. Then if the contribution is up to 10%, then up to 10% of the salary shall be allowed as deduction under section 80 CCD2. That means first it will be allowed, added to the salary because employer is contributing, employer is paying money. So that is to be treated as employee's salary. Then if it is 10%, then fine. If it is more than 10%, then up to 10% shall be allowed as a deduction. Okay, this is the treatment of employer's contribution towards NPS. And employee's contribution, you see, up to 10% of the salary shall be allowed as a deduction. Employee's contribution, it is allowed as deduction under section 80 CCD1. Okay, this is about employee's contribution. Employee's contribution is 80 CCD2. Employee's contribution is 80 CCD1. Additional contribution up to 50,000 can also be allowed as a deduction under a different section, that is 80 CCD1B, under different subsection. So employee's contribution is allowed. Additional contribution of 50,000 is also allowed. And you have to see one more thing. Aggregate deduction under section 80C, 80CCC, 80 CCD1. CCD1 means employee's contribution shall not exceed 1,50,000. But you have to see 80 CCD1B is not included here. That means under section 80 CCDB, one can contribute another 50,000 rupees. That means total deduction one can claim is 1,50,000 plus 50,000. 2 lakh deduction is possible if contribution is made for NPS. So additional deduction to NPS 50,000 will be allowed as an additional contribution of 50,000 will be allowed as an additional deduction. And this pension received from this fund is taxable. Okay, and here the salary means salary plus DA if it is forming a part of retirement benefit, and commission if it is fixed as a percentage of turnover. So this is the treatment of contribution made to employees' pension scheme. It's a national pension scheme. Understood, friends?
Yes, sir.
Okay. So there may be one more fund called as approved superannuation fund. Deduction is allowed under section 80C in respect of employees' contribution to approved superannuation fund. Interest received from approved superannuation fund is exempt. Employer's contribution to approved superannuation fund is exempt to the extent of 1,50,000 per year per employee. If it amount exceeds 1,50,000, the excess amount shall be taxable in the hands of employee. Employer can contribute up to 1,50,000. And amount received from approved superannuation fund is exempt under the provisions of section 10. So this is the treatment of approved superannuation. Okay.
Yes, sir.
Approved superannuation fund means it is a fund which is approved by Commissioner of Income Tax. Now, friends, having understood that various components of salary and how that will be taxable, now let us see what are the deductions allowed from salary income. Friends, try to understand the deductions are allowed. There are certain deductions which are allowed from gross total income. As you know, that we arrive at the gross total income. How? We compute salary income, income from house property, profit and gains of business and profession, capital gains, and income from other sources. After that, we make two adjustments. That means clubbing income provisions are applied, and setup and carry forward losses are also adjusted. After that, we get gross total income. Therefrom, from that gross total income, we make this chapter 6 deductions. So 80C to 80U. Now we are discussing about 80C deductions up to 1,50,000. And also, I was telling you this thing, another 50,000 deductions are allowed here. Here you see 80CCD 1B. So total under 80C and 80CCD 1B, one can claim 1,50,000 plus 50,000, 2 lakh rupees deductions can be claimed. So these deductions are allowed here, chapter 6 deductions. Then you get total income and you compute your tax. Okay, this is what we have understood earlier. Is it?
Yes, sir.
Okay, but under each of these heads, there are certain deductions. Now we are going to learn deductions allowed under salaries chapter, under the head salaries. Under the head salaries, 3 deductions are allowed. We'll be seeing that. Okay. Similarly, for every head, there are certain deductions. Okay, salary head, what are these 3 deductions? One is standard deductions will be allowed. That standard deduction means it's a fixed deduction, irrespective of your salary, irrespective of your money you spend to earn that salary. A fixed amount is allowed as a deduction. It's a fixed amount of 50,000. We'll be seeing that. Deductions allowed under the head salary are there under section 16. Subsection 16.1, 16.2, and 16.3 will be learned. And the second deduction which is allowed is professional tax or tax on employment. If tax on employment is paid, that will be allowed as a deduction. And the third deduction will be entertainment allowance, that also will be learned. Now let us see one way. So these are the deductions which are specific to salary. Similarly, there will be certain deductions which will be specific to income from house property at that point. At appropriate time, we'll be learning that. Okay. So now when I say deductions, these are not the deductions which are allowed from gross total income. Gross total income deductions will be allowed here. After gross total income, then we allowed certain deductions here. But now I am talking about deduction under the chapter, under the head salaries. Okay, friends. Now let us see that. So, these are the components of salary: basic salary, allowances, perquisites, profit in lieu of salary. And deductions are three: you see. Standard deduction, professional tax, entertainment allowances. These are the three deductions only which are allowed. Okay, what is the meaning of profit in lieu of salary? We have discussed all this thing earlier. Okay, if you have not discussed, then just have a look. This is the meaning of profit in lieu of salary. It is defined under section 17(3)(2). So any compensation due or received from employer or former employer in connection with termination or modification of terms and conditions of employment, that is profit in lieu of salary. Any payment due or received by an assessee from employer or former employer, and there are certain exceptions to that, like gratuity, commuted pension, all these things: retrenchment compensation, statutory provident fund, public provident fund, recognized provident fund, and this thing approved superannuation fund, HRA. All these are exempted, except that if any other payment is received, that is profit in lieu of salary. Any payment to unrecognized provident fund and other fund, to the extent it does not consist of contribution by assessees or interest of such contribution, so those payments are also profit in lieu of salary. Then sum received under key management personnel insurance policy, including its bonus. Then any amount due or received, whether lump sum or otherwise, by assessee by any person before joining employment or after cessation of employment. All these are profit in lieu of salary. So why we are learning this? Because this is also a component of salary. If some employee has received any amount like this will be called as profit in lieu of salary, and that will be taxable. Okay. So salary includes all these things: basic salary, allowances, perquisites, and profit in lieu of salary. And from this, these three deductions are allowed: standard deduction, professional tax, and entertainment allowance. Now let us see what is standard tax. Let us refer to section 16(1)(a). So standard deduction, as you can see, it is an amount of 50,000 or the amount of salary whichever is lower. If someone is earning a salary which is lower than 50,000, the standard deduction will be limited up to this, up to that. Let us say person's salary is 45,000, the standard deduction will be how much? Whichever is lower, 45,000. If someone is, his income is 1 lakh, how much will be the standard deduction?
50,000.
And somebody's income is, let us say, 30 lakh, how much will be standard deduction? Same 50,000. 50,000. So therefore it is called as standard deduction. That is a fixed amount which is allowed to be deducted. Okay, so that is standard deduction. Then one more deduction is called as entertainment allowance. So entertainment allowance, if it is received by non-government employees, then see that it is not taxable at all. It is fully taxable. It's not exempt at all. No deduction. It is fully taxable. But if it is received by government employee, the minimum of following will be deducted. What is the minimum of these three things? In fact, one is entertainment allowance received, that means actual allowance. Second is 1/5 of basic salary. Third one is rupees 5,000, whichever is lower, you have to see. So that amount will be exempt. So maximum rupees 5,000 rupees can be exempt. Okay, entertainment allowance if it is received by government employee. For other employees, it is fully deductible, it's fully taxable, no deduction. Understood?
Yes, sir.
Okay. Now, professional tax. Professional tax is one more deduction allowed from salary income. And it will be, this deduction will be allowed in the year in which professional tax is actually paid. So if employee is paying professional tax, the amount whatever he is paying, that will allow as a deduction. If professional tax is paid by employer or it is reimbursed by the employer, you see it is an employee's liability, but it is made by the employer. So it behaves like a perquisite. In that case, what will happen? First, it will be included in the salary as a perquisite. And then the same amount will be allowed as a deduction under section 16(3). Okay, first it will be included as a perquisite, then it will be deducted if it is paid by employer. But if it is paid by employee, then it will be straightway deducted. Okay. Professional tax is a state tax, so it varies from state to state. So, for example, if you take a particular state, let us say take the state of Odisha. So, this is the amount of professional tax when one has to pay, employee has to pay. If the monthly salary is up to 13,304, nothing has to be paid. And above that, 13,304 to 25,000, 125 rupees per month is payable. Above 20,000 monthly salary we are talking about. So 200 rupees per month, except for the month of February. And for the February, it is 300 rupees per month. Okay, that means every month 200, for 1 month it is 300. So totally it comes to 2,500. Okay, 2,500 rupees per annum will be paid. This is called as professional tax. Okay, and mind you, this varies from state to state. Okay, you can visit to the website of Odisha Commercial Tax Department. You can find out these rates. Or from any state's commercial tax department site, you can find out these rates. Okay, friends?
Yes, sir.
Okay, so now broadly we have seen that how deductions will be allowed, how salary, various components of the salary will be valued, then how deductions will be allowed. Then one more concept, which briefly we had discussed earlier. Let us learn that thing also. That is, if someone is receiving some areas of salary, you know, many times government employees and other employees, they receive areas, isn't it? Let's say 5 years, some increment, they got it today. And because of that area, what happens? They receive more salary in a particular year. Isn't it? It's the past 5 years area was there. This year they received 5 lakh rupees extra. Since this year, in the current year, they are receiving 5 lakh rupees extra. What will happen? They have to pay more tax because people who are at the lower slab are moved to a higher slab because they are receiving some areas. You know, income is taxed at a slab rate, isn't it? So up to 2,50,000 male, then 2,50,000 to 5 lakh 5%, then 5 lakh to 10 lakh 20%, then above 10 lakh 30%. Let us say someone's salary is was annual salary was 9 lakh. So maximum he was paying tax at the rate of 20%. Isn't it? Some part nil, some part 5%, and some part he was paying at 20%. Isn't it? Yes or no?
Yes, sir.
But let us say his income is 9 lakh rupees, but he received 5 lakh rupees a year. Now income moved to 14 lakh. Okay, 9 lakh plus 5 lakh. Are you getting
Yes, sir.
14 lakh? And the 14 lakh. So up to 10 lakh, he'll be paying tax at the rate of 20%. And beyond that, beyond 4 lakh, he has to pay at the rate of 30%. So he's moved to a higher rate. Okay, because of this area. If this area would have been received in past 5 years, there is a possibility that he could have managed with lower rate. Is it not? He
Yes,
could have
sir.
paid tax at a lower. So this is creating a hardship to the employee or to the assessee. Because of this area receipt, he is paying tax at a higher. So therefore, in this kind of situation, a relief is allowed under section 89. So assessee or employee can claim relief. Okay. So let us see the what section 89 says. So 89 in summary, what it talks about, if for some reason an employee is receiving salary for more than 12 months, that means either past year salary is receiving, or maybe he's receiving for future year. And because of that, his income is assessed as a higher rate than that at which it would otherwise have been assessed. Okay, let us say otherwise it would have been assessed at 20%. Now, because of this area, he's assessed at 30%. In that situation, the assessing officer shall, on application made by the employee on his behalf, may grant a relief. In that situation, he may grant a relief. Okay, how that relief will be computed? Process is very simple. You have to compute that. Okay, now you see this table, you'll be able to understand how the relief will be computed. Now you see logically, you see how relief will be computed. First, we'll assume that this particular income, let's say areas income, were received in respective years. Then we will be finding out in that situation what would have been the additional tax. And if the same income is received in the current year, now how much is the additional tax? Are you getting me?
Yes, sir.
Okay. So if in the current year additional tax is more, he'll be allowed a relief. How much is relief? Relief is the difference between the additional tax that he has to pay now and the additional tax that he would have paid earlier. Okay, if I put this in a table, now I think it will be better if you look at this table. It will be more clear to you. Now you see, let us learn it in these 5 steps. Then what we'll do? Step 1, calculate tax payable in the previous year in which the arrears or advance salary is received. Okay, in the previous year when it is received, let us say it is received in this year. So calculate the tax payable in this year. Okay, how will we calculate? First, you will calculate total income inclusive of additional salary and total income exclusive of additional salary. Let us say you have received arrears for 5 years. So first include that thing, find out what is the tax. Then excluding that thing also, you can find out what is the tax. Okay, then you can find out what is the additional tax because of arrear. Is it not? Step 1, did you understand? Let us say your current salary is 20 lakh rupees and you received arrear of 5 lakh rupees. So calculate tax on 20 lakh rupees. Also calculate tax on 25 lakh rupees, including arrear and excluding arrear. That is step 1. Step 2, compute the difference. Difference means what is the tax between these two. Tax on 20 lakh and tax on 25 lakh. Okay. Understood? Step 1,
Yes,
2
sir.
is clear. Now step 3. Step 3 will go back to the earlier years. Step 3, what will do? Calculate the tax payable of every previous year. Let us say it is for 5 previous year. For every previous year, you have to calculate to which the additional salary relates. Let us say additional salary relates to past 5 years. For past every 5 years, you have to calculate the tax payable. How will we calculate? How will be calculating? Then again, including of this additional salary and excluding of that additional salary. Okay, let us say past 1 year, how much is the additional salary you have to see. Every year you have to see that how much is the additional salary related to that particular year. So including that what is tax and excluding that what is tax. So on total income, including additional salary for a particular previous year, and on total income, excluding the additional salary. Then if you compare these two, then we can find out how much additional salary would have been paid if the income would have been included in earlier years. Is it not? Yes or no?
Yes, sir.
Now calculate the difference between step A and B, and this difference you find it. That means if it would have been included in earlier years, let us say you should have paid 1 lakh rupees extra. But now when you are including here, you are paying 3 lakh rupees extra. Okay, so you should have paid 1 lakh rupees extra, you are paying now 3 lakh rupees extra. That means 2 lakh rupees should be allowed you as a relief. Okay. So what is relief? Relief under section 89(1) is the amount calculated in step 2 minus the amount calculated in step 4. Step 4 is the step 2 is the difference here in the current year with arrear, without arrear. Step 4 is the difference in the previous years with arrear, without arrear. Okay, this is how you can calculate relief under section 89(1). Will you be able to calculate?
Yes, sir.
Now you see, for this calculation also, you can also adopt a shortcut method. What you can do, let me show you. Let me take you to Income Tax Department's website right now. Give me a minute. So I'm taking you to this Income Tax Department website, incometaxindia.gov.in. Just give me a second, site is opening slowly. So as you're aware that we can use various calculators, is it not?
Yes, sir.
So we have understood the law, section 89(1). You can read the section 89(1) and you can also use calculator. Now, let me tell you this thing. Go to apps. Income Tax Act, which section I told you, section 89. You can always, I request all of you, when you are learning a particular section, you can check it from the act itself. So we are looking for section 89, right? Now, are you able to see section 89? What is the title?
Yes, sir.
Relief when salary, etc. is paid in arrear, right? When it is paid in arrear or in advance. Now you can read that provision. Yes. So what I told you is the same thing is written here. If the assessee is in receipt of nature of salary being paid in arrears and advance, okay, or is in receipt in any one financial year of salary for more than 12 months. And the same thing, what I told you, the same thing is explained here. The assessing officer shall, on application made to him in this year, grant a relief. Okay, how the relief will be computed, if you want to understand, simply logic I explained you, but if you want to calculate it, then we can do one thing. Just a minute. So friends, as you are aware, or some of you might be aware, that today is the last day of this financial year. Yes or no? Okay. And today there is a last date of filing some returns and some forms also with income tax department. So throughout India, a lot of people are filing. Filing is going on, and that is why Income Tax Act is UK. This site is moving very slowly. Okay, today is the last date for filing various, not only returns but various forms. So everybody is doing that. Today you see site is damn slow. Yeah, I was telling you this calculator from section 18, 18. So where you see tax calculators are here, can you see
Yes, sir.
tax calculators? Oh, it's not working now. So it shows server is busy. I will try again. Friends, you see through this link, um, see tax tools I'm going. Income tax department website, tax tools. You can see various tax tools are there. Here you can find calculators, you see. Okay. And we are looking for the tax calculator for relief under section 89. You can go to the next page.
Yes, sir.
Just a minute. First page, that calculator is not there. But thankfully, first page open. Let us see the second page. Second page, again, you see we are not finding that calculator. Let us go to page 3. Page 3 is not opening. Now you see page 3. Are you able to see it here? Relief under section 89.
Yes, sir.
So here this calculator will be helping you. Sorry, again it shows the server is busy. Today being the last day of the financial year, this type of uh, problem will be there. Server is actually too busy, but anyway, I think it's opening. The calculator is opening slowly. It is opening, but it is not showing the complete view. But you can see relief under section 89 can be calculated like this. You can put the assessment year, previous year, tax status, residential status, DOB, gender. You see salary received in details. Okay, or gratuity received for past years. Suppose salary received in areas. You can enter details by clicking here. So after selecting the assessment year, let us say for a particular assessment year, say for 21-22, I am selecting because 22-23 has not yet started. After a few days only it will be starting. Tomorrow onwards it will be starting. Let us say for resident. Now we'll put details here. Enter the salary details. Okay. You see, actually this is complete view is not coming because this server problem. You see here, once you put the data, you can find salary received in area. You have to give data for which year, how much of salary you have received. Okay, preceding years for different years, you have to give the data. So finally, it will be calculating what is, if you click calculate, it will be calculating relief under section 89. Okay, we will be able to do it.
Yes, sir.
For different years, you have to put, in fact, the data. What is your normal income and what is the area relating to that year? You have to put that data. You have to also put data about your current year's income, current year's total income, and what is the previous year's income you are receiving in the current year. If this data are fed into that calculator, it will give you relief under section 89. And when filing your return, you'll be able to claim that. Okay. I think you'll be able
Yes,
to
sir.
do.
Yes,
Okay.
sir.
So friends, broadly, we have completed these aspects, how salary income will be treated. Just few related points I would like to discuss with you right now. Having understood how salary will be taxable, a few other related points. Just give me a second. Yeah, relief under section 89, you can calculate. Deductions will be learning separately. Okay, one important thing related to TDS and related to salary is TDS. Many times employees are worried that how much tax will be deducted. Employers are also worried that how to find out the exact amount of TDS. Friends, try to understand. For salary, there is no rate at which, no fixed rate at which you can deduct tax at source. You know, employers deduct tax at source. Is it not? So
Yes,
it is
sir.
the responsibility of the employer. If employee is liable to pay tax, he has to deduct tax at source. How he'll be computing? He'll be computing actually for salary, since there is no defined rate. You have to find out what is the tax liability of the employee. And he need to, every month he need to deduct amount in such a way that the entire tax is deducted at source. Okay, for which he may collect information from the employee. And on the basis of that information, employer is expected to deduct tax. Salary is subject to tax deducted at source under section 199. It's the obligation of the employer to deduct tax at source. If employer is not meeting that obligation, he has to face the consequence of penalty and prosecution. Okay. Employee in any way cannot escape from this liability. Employee cannot say that employer has not deducted. That is not so. Primarily, it is the liability of the employee. If employer has not deducted, that's a different thing. That is his obligation. He will be facing its consequences. But ultimately, it is the liability of the employee. Employee has to pay tax. Okay. And the employer, after deducting, it need to deposit the money with government through challan, through TDS challan. So normally, on or before 7 days from the end of the month in which deductions are paid, it has to deposit it. That means suppose deduction is made by January, then it has to deposit it by February 7th. But however, if the TDS credited during the month of March, then there is a time before 30th April that can be deposited. Otherwise, by 7th of every month, 7th of the following month, it should be deposited. This is one more obligation one has to keep in mind. It can be deposited electronically some other day, or today, if possible, I will show you how this amount to be deposited. And after depositing, TDS returns also needs to be filed on quarterly basis. So that is also one more responsibility of the employer to ensure that quarterly TDS returns are filed. Okay, this is one more thing I wanted to discuss. Now, friends, you must have seen when you are learning this heads of income, the meaning of salary keeps on changing at different situations. For gratuity, meaning of salary is gratuity in case of non-government employees covered under Payment of Gratuity Act. The meaning of salary is basic salary plus DA. For all these things, let us say gratuity for non-government employees not covered under Payment of Gratuity Act, leave salary, house rent, allowance, recognized provident fund, voluntary VRS scheme. The meaning of salary is basic plus DA if it forms a part of employment benefit, plus commission calculated as a fixed percentage of turnover. That is the meaning of salary. So salary meaning is different from different point of view. For rent-free accommodation, the meaning of salary is again like this. All payment allowances, bonus, commission, or any monetary payments by whatever name called, but it excludes DA, employer's contribution to PF, allowances which are exempt from tax, perquisites specified under section 72, any payment or expenditure specifically excluded under the provisions of 72, okay, like medical insurance premium, lump sum amount paid, so paid for certain superannuation or some under certain schemes. Okay, so excluding this thing, salary includes all other things, pay, allowances, bonus, etc. So the meaning of salary will vary. So with this, friends, broadly we have understood that how to deal with salary. Okay, right now what I'm going to tell you, we know how to compute income, salary income we know, but it's the basis of income also we know. How to, that means various heads of income we're aware of. Now we are also knowing that how to use the tax calculator to calculate the tax liability. Now friends, quickly let us learn how to pay the income tax. Once you know this is my income, this is my tax, how that has to be paid. For that thing, once again, let me take you to the income tax department's website. Plus, just give me a second. Tax payment or TDS payments. Just have a look here. Well, friends, site is moving very slow. We will not be able to see that thing right now. But at some other day, I'll be showing you how to make the tax payment. Online payment. Yes. Today, since the income tax department site is not working, so this some other calculators relating to salary, we are unable to use it. So I'll be some other time we'll be seeing that thing. Otherwise, also you'll be able to manage. And one thing relating to tax planning aspects of salary income. So as you have already seen. So if employer plans the salary structure in such a way, you know, there are certain allowances which are exempt. Okay, certain perquisites which are also exempt. Then it will ultimately this employee can be benefited. So it requires some kind of planning from the employer side. And from employee side, what employee can do, if employee can make suitable investments, like so that he can get the benefits of ITC, let us say PF contributions, or let us say investment in national savings certificate or health insurance. Okay, so these are for all, not for employees. Maybe for pension scheme. If this kind of contributions are made, the employee can also save some funds. So there is a lot of scope as regards to tax planning with salary income. Once you have understood the subject, then you can apply your mind how to reduce the tax burden. Okay, friends, we'll stop our session here today. And the next session, I'll be showing you some other things. Thank you very much.
Thank you, sir.
Thank you, sir.